So let me, I did prepare a couple of slides just to kind of have it here. Let me put it up just to get oriented. So we have one scheduled for today. The next workshop is next week, and then one the week after. And what would be helpful to me, and I think to you as well, and Hussein and Chili, you're welcome to send me some questions too. If you have any questions, we can kind of engage in the discussion. You're welcome to do that.
Mm-hmm.
Yeah, can do that.
Yeah. I'll be back here next week and the week after that. And we can stay as long as you need to, although we're allotted 1 hour until about 6:30, but I'm welcome to stay longer if that's necessary. So here's some of the questions that that Jade posed earlier. Let's get started with these discussions. Do clients need to put retirement assets in trust? And let me, since you posted these questions, Jade, let me pick on you a little bit. Maybe you can expand on this question and we can put it in context and provide some background. In terms of retirement assets, what are you thinking about?
Like 401k account
401k?
and yes, and IRAs.
IRAs?
And like heritage pension plans and everything.
Yes.
Yeah.
Generally speaking, 401ks and pension plans that are sponsored by an employer or corporation cannot be put in trust. These assets are transferred at death based on the beneficiary designation forms. And what happens is the beneficiary designation forms are provided to the employee when the employee starts working and they're eligible to contribute to a defined contribution plan like a 401k or a 403b. They have to fill it out and list on that beneficiary designation form who they want the asset to go to after their death. And the form has 2 or 3 different slots. And it could be the first beneficiary would be the spouse. The second beneficiary could be a cousin or a child or a parent or a sibling in any order as the employee wants to list. Now, with respect, and those are the employer-sponsored pension plans. With respect to IRAs, there's a little bit more flexibility. To answer your specific question, the asset itself, the IRA itself, or the SEP IRA, or the simple 401k, and I don't know if you're familiar with it, I'll give you a little bit of background. There's something called a simple 401k plan. And we're taking a little tangent here, providing with some background about these investment vehicles, kind of put this into question in context and give you some broader background. There's something called a simple 401k, which is restricted to sole practitioners, and there could only be 1 or 2 individuals who are participating in the 401k, and it would be the sole practitioner himself or herself and the sole practitioner's wife. That's the simple 401k. The company cannot have employees. If there's employees, then the entity has to form a regular 401k, which is more expensive and there's more compliance involved. There's additional filing forms with the IRS and the Department of Labor. Simple 401k, there's some advantages to having a simple 401k than there is to having a SEP IRA. And are you familiar with the SEP IRA? Do you know the difference between a SEP IRA and a simple 401k?
No.
Okay. A SEP IRA is similar to what excuse me, just one moment. Let me close my door.
So Jay, if you're preparing for the CFP exam, one thing to make sure you remember is the SEP IRA is not considered a qualified plan. That's something that always people get confused, because by the definition itself, it is not.
Okay, thank you.
Yeah.
A SEP IRA is an employer-provided plan, and generally a lot of small businesses and self-employed individuals, and hence the word SEP, S-E-P, it's a self-employed IRA. There's some restrictions to it. I have a SEP IRA myself that I contribute to every year. It is an IRA, so it does come under the IRA rules under the Internal Revenue Code. And there's some limitations of how much monies can be contributed into a SEP IRA. Only the net income of the business could be used to compute the contribution into the IRA. With the simple 401k, additional funds can be contributed in addition to the net income of the business. The 401k amount can also be contributed over on top of the net income of the business. So a company that has a simple 401k, the owner, the proprietor, can contribute more into a simple 401k than they could contribute into a SEP IRA under certain circumstances based on their income.
So I guess this is an important factor to remember. So simple 401k versus SEP. So SEP is calculated based on 20%, up to 20% of the net income of the company. That amount is deductible in business expense. Simple IRA contribution, if it's employer's contribution, that's also deductible. The employee's portion, that's not deductible from a business perspective. So that's why SEP IRA is much more attractive to business. Like my business, I have a SEP IRA as well. And because of the amount is up to 20% of the net income, and that's also deductible, that's a lot more attractive. The downside of the SEP IRA is that if I were to have employees, let's say if I contribute to me as an owner of 20% up to the net income, I have to contribute the same 20% to every single employee in my firm. So that will be considered as a downside because you have to have enough cash in the business to do that. So there's some advantages and disadvantages, but from a SEP perspective, from a smaller firm perspective, it makes a lot of sense.
Yes, that's correct. Where the employer, in addition to contributing to the individual owner of the business, if there's employees, the employer has to make a contribution for every single employee. There's some limited restrictions where there's a time period where an employee has to be employed for a certain period of time until they can
I think that's based on the plan document. So if your plan document indicating that, so the trick is that, okay, in my case, I knew that's going to happen. So then I'm going to just put 3 years, right? For employees to stay in the company 3 years to qualify, then I don't have to worry about it until that time. So the plan document actually gives that definition, if you will, and it's still giving the owner the full control of who they wanted to contribute.
That's right. But when they pass that time limit and the employer makes a contribution, they have the burden of contributing, the financial burden of contributing for everybody.
That's right.
In addition to themselves, which for small businesses that have employees, it becomes a very costly.
Right.
Now the difference with we're kind of taking a little tangent here, but I think it's an important point to know and understand. The difference between the SEP IRA and the 401k, and I just want to clarify one point that I made a little earlier in our conversation. If we have and I don't remember what the maximum contribution for SEP IRA is for 2020. I think it might be
Yeah, I think it's like
58,000.
Yeah, 58,000. That's the total
58,000,
maximum.
and
Yeah.
yeah, and that let's see, what 58 divided by 20%.
So
If somebody makes a net income of 290, more than 290, they can contribute the maximum into the SEP. They can't contribute anymore.
So keep in mind that because it's coming from the net income of the business, it's not coming from the revenue of the business. There's a big difference. A lot of people get confused. It's the bottom line, the net income 20%. So, but the 20, even if you are able to contribute up to 58,000 as a maximum, it is still a lot more deduction you can take out from the business compared to a regular simple 401k where the employer's contribution portion of it is probably not going to be that much. So it makes sense to be a smaller business, probably a husband and wife team, and most likely very little employees, just to take advantage of that.
Yeah, let's compare that to the simple 401k, where, and the benefit of the simple 401k, and I can give you a hypothetical scenario where it would be more beneficial to have a simple 401k than to have a SEP. We know in the previous example that we just mentioned that somebody who makes 290 or more can contribute the maximum of $58,000. Let's say we have a business professional or a small business owner that's making $100,000 of net income per year from their self-employment business. And based on our ratio, they can contribute $20,000. That's if they have a SEP IRA. Now, if they have a simple 401k, they can contribute the 401k amount plus 20% of their net income. They're not restricted by just the 20% of the self-employment income. So under certain circumstances for businesses that are making less than that 290, it may make sense to have a simple 401k as opposed to a SEP. Now, the maximum in the 401k cannot be more than 58, but for a business that's making a net income of less than 290, having a simple 401k, they can put more. If they have the financial wherewithal, of course, they can put more than they would be able to in a SEP.
Now, can I just ask something? So
Sure.
Not to get into the complexity of your question, but so typically between simple 401k, SEP, IRA, as well as simple IRA, because there's also a simple IRA.
Yes.
And then depending upon the client situation, oftentimes we may or may not be in the best position to do that, but the very first thing that I typically do is I have to see the list of employees, their salaries, and you have to make some calculation to see which one of these plans is actually much more beneficial to the owners. Because keep in mind, the owners are the one that oftentimes you're working for. The employees oftentimes. Oh, I'm muted. Sorry. The employees oftentimes is a byproduct of it. Most of the owners that I work with, that they do want to contribute for their employees, but not to 20%.
Yeah.
So you have to kind of see what the owner's objectives are and then plan accordingly. And also take companies' cash flow into the consideration. Certain industry is probably not a good fit for simple IRA. Like construction industry, they tend to be heavy on the equipment side, and the cash flow oftentimes is not as good as other professional services. So they tend to stay within the simple IRA round. But not to confuse you on the plan, but I want to go back to your questions on the retirement assets. Yeah. If the retirement assets is based upon these plans that we are just talking about, then you are right. You cannot, it doesn't make sense to put it in trust. Even the beneficiary self still doesn't make sense to put it in trust. So it's better off just go to an individual person, because it has something to do with the distribution rule. Trust as an individual, individual entity versus a person, it has something to do with the minimum distribution. So that's probably the primary reason that if it's a qualified or retirement plan, it probably doesn't make sense to put it in trust, even the beneficiary to trust, because of that entity and individual minimum distribution rule.
Yes, the asset itself, the 401k or the IRA, cannot be put in a trust.
That's right.
What is possible, and it sometimes happens by default, where the beneficiary designation is somebody forgets to put an individual as the beneficiary designation. They forget to fill out the form. And by default, when the form is not filled out and the form is blank, the default is the estate of the individual.
That's right.
Ends up receiving the funds, receiving the balance of the IRA.
And I think that because if that's the case, then it goes through a probate, versus if it's go through, if the beneficiary is an individual, then it automatically transfers to individual. If it goes to stay, it automatically goes through the probate process.
Yes, yes. Now there are certain circumstances where the beneficiary can be a trust. Very limited circumstances.
Sorry, excuse me. Excuse me, Professor, you said the beneficiary can be the trust?
Yes, it can be the trust.
Okay.
And it could be the individual's revocable trust, the living trust, or it could be another trust set up for a child or for some other individual or family member. Now, this was very popular before the Secure Act came about a year ago. And the reason why individuals did include or put the name of a trust as the beneficiary of an IRA or a 401k is to protect the recipient of those funds. Now, before the Secure Act, individuals who inherited an IRA or a 401k were able to defer the receipt of the funds over their life expectancy. There's very complicated rules that we don't need to get into at the moment. But suffice it to say that individuals were able, who inherited 401k plans or IRAs or SEP IRAs, were able to delay receipt of the funds over their life. What happened is the Secure Act changed all that. Now, the lion's share of beneficiaries of 401ks and IRAs and SEP IRAs, et cetera, have to receive the entire amount, the entire balance in the fund at the end of 10 years after the death of the owner. So previous to the Secure Act, we have, let's take a hypothetical example. We would have an individual who has a child who is not very financially savvy, who's a spendthrift, is not taken financial planning classes, and the parent does not want the child to get all of these funds or have access to these funds. What they did in that circumstance, they would have a trust set up for their child, and they would name the trust as the beneficiary of the retirement plan.
So can I ask a question? You said the inherited 401k or IRAs, the beneficiary must distribute in 10 years. What about for the child? The child must distribute the asset in 10 years also, to
Yes.
our child?
Yes, the administrator of the plan has to distribute the funds to the beneficiary and all of the account has to be emptied out at the end of 10 years.
So Jay, just to let you know that rule, what Haraj was talking about, that was the Secure Act changes in October of last year. And that's actually is going to be part of what the July CFP exam now is being postponed to September. So if you are planning to take the exam in the July, yes, this is the rule you need to remember. It also has something to do with that. It has something to do with whether or not the person had already started distribution or not. If it hasn't started the distribution, then 10 years is the only way. And so according to what Haraj was just saying, then when you put the beneficiary into the trust, even if it's a revocable living trust, it doesn't necessarily make sense today because of that 10 years rule. And you have to kind of judge whether or not that's the best thing for the family to do. Now, if it's a situation for someone who is special situation for a child who is disabled, or they wanted to make sure that the child has some sort of spendthrift on it, then going to a trust does make sense. Even if it's distributed in 10 years, the trust still has saying how much it will go into the beneficiary. So in some situations, it still makes sense to be inside the trust. I hope that's correct, Haraj.
Yes, yeah, and this new rule applies to owners of retirement accounts that die on January 1st, 2020 or after.
Mm-hmm.
So for all of the individuals who inherited before this date, they can still get the balance of the IRA over their life expectancy. In order for this retirement asset to be in the name of the trust, and I'm taking a step back here, looking at the old rules, the trust has to be drafted in a special way. And the common term for that trust is a look-through trust, look-through, where the IRA looks through to see if there are individuals who are beneficiaries of the trust. And if there's individuals who are beneficiaries of the trust, they could take that distribution over their life expectancy. But after January 1, 2020, that has changed, and almost everybody is stuck to get the assets of the retirement account over a 10-year period. Now, there are some exceptions. There are some exceptions, which, since we're on this topic, I think it's good to know those exceptions. A surviving spouse, a minor child, a disabled child, a chronically ill individual beneficiary or a disabled beneficiary, and lastly, an individual, a beneficiary who is within 10 years in age of the owner of the account. That group that I just mentioned, those 4 or 5 special types of individuals, are able to get the balance of the IRA over their life expectancy if they were named the beneficiary. So for that reason...
Can I just interject for a moment? So Jade, the Secure Act portion that Haraj just mentioned, in the capstone class, I have provided a link to that video. That video actually has a lot more detail that is worth your time to watch it again, because that will impact the actual CFP exam.
I will. Yeah. Thank you.
So there are, even with the change in the Secure Act, there are some circumstances where it would make sense to list the beneficiary of the retirement account as a trust, even though the funds are going to be have to come out of the IRA and into the trust at the latest in year 10. There are certain circumstances where it would still make sense to have a trust accept those funds. And that would be a situation where we have a spendthrift, or we have a beneficiary who has issues with drugs or alcohol. There's also a situation with special needs individuals who the chronically ill or the disabled individual, the special exception type individuals. If those are named beneficiaries of a trust and the trust is the beneficiary of the retirement account, those individuals, if the trust is drafted properly, those individuals, because they're part of this special group called eligible beneficiaries, they will be able to take the distributions out over their life expectancy.
And I think include a child, a minor, yeah.
Yes. Now, one
because the age.
clarification, one clarification point of the minor child is a minor child will be able to stretch or get the distribution over their life expectancy up until they reach the age of majority. Now, this rule was put in place, but from a practical perspective, I can't imagine this situation being very common, because most individuals who die are older, and typically most individuals who are in their 70s or 80s are not going to have minor children who are going to be benefiting from this rule. The situation where it might occur is an individual who's younger, who gets sick or dies in an accident, may have a minor child who could take advantage of that. And generally speaking, for the most part, those individuals are going to have their spouses as the primary beneficiary, and a minor child would be a secondary beneficiary. So even in those cases where if you have a younger individual dying as a result of an illness or an accident, that category is not going to be very common. The minor child category, that eligible beneficiary category. So let's move on to the second bullet point in terms of titling real estate assets, whether they have real estate assets as joint tenants with right of survivorship or putting in a trust. Now, there's another type of titling. There's more than these two titling types of assets. One of them is common in California, which is community property with right of survivorship. And it's not mentioned here, but I'll discuss this shortly. There are some tax advantages of titling an asset as community property with right of survivorship. There's one other titling that's common in the Midwest and Eastern states that functions similar to a joint tenancy and provides some asset protection that is not available in California. So in terms of what type of titling makes sense as far as real estate is concerned, the most important point early on is to determine the purpose and what the individual or what the client is trying to accomplish here. And the strategy of putting assets as joint tenancies or putting them in trust is what? What do you think? Chiali and Hossein, you can't answer that question.
Orderly distribution and privacy.
Probate, avoiding probate.
Avoiding probate.
Avoiding probate.
Privacy.
Yeah.
That's the privacy part.
Right, exactly.
But we can avoid the probate through the title.
With joint tenancy.
Yes.
Correct.
But that's only once. So let's say if it's a husband and wife, husband die, the title then pass on to the wife. If it's not trust, then that wife dies, it will goes to probate. So you can't
Correct.
completely avoid that. Only trust can do that.
Correct. The Jade, you're right that if you titled it as joint tenancy, it would avoid probate at the first death of either owner. And it doesn't have to be spouse, it could be.
Yeah, it could be anybody.
Oh, the second death. Okay.
Yeah,
I got it.
At the first death. At the
Yes,
second death,
yes.
if they don't do anything, if the survivor of the two or the three joint tenants, and it doesn't have to be two, it can be 3, 4, 8, whatever. Typically it's 2, but that's not mandatory. The survivor has to do something, has to either do trust, and there's another option in California, which is similar to a beneficiary designation form called a transfer on death deed, TOD. Now, it depends on what the individual, the client, wants to do. Obviously, putting it in trust requires some planning. Requires to have an attorney draft the estate planning documents, and you may have covered this in your course. The estate planning documents is usually a package of several documents that go hand in hand. You have the living trust, the trust document. There's usually a will that accompanies the trust. There's a power of attorney for financial, the financial power of attorney, typically referred to as a general power of attorney. There's the healthcare directive, which is a power of attorney for healthcare, which allows the individual to make healthcare decisions. And then there's the fifth document, which is the living will, or some jurisdiction, there's a document called the POLST, P-O-L-S-T, which determines life extending treatment if somebody is on life support, etc., which is similar to a healthcare directive, but it's a different document. So generally, the attorneys who get involved in drafting estate planning documents put this package of 5 documents together for their clients. I did come across a situation recently, last year, where husband and wife didn't have any children. They had a business and they had a home, a residence, but for some reason they did not like, or they did not want to have their attorney draft a trust for them. So they held the real estate, both the business and their primary residence, as a joint tenancy with right of survivorship. And the husband died about a little over a year ago now. And the surviving spouse, the wife, inherited his interest. So she inherited the interest, no probate from a probate perspective. However, there was a problem from an income tax perspective, and this is the problem. And tell me if you recall this rule. When somebody dies, there's a step up or down in the cost basis of the asset to fair market value.
Yes.
You're familiar with that rule. Okay. And a lot of times, a lot of professionals refer to it as a step up because assets were acquired years and years ago at a lower price point at that time, and property values had appreciated. And that's true most of the time, but that's not necessarily the case all of the time. Because if the value has decreased,
oh, yeah,
the value on the date of death is the value that determines the cost basis of the property in the hands of the individual that inherited it. So always keep that in the back of your mind, the fact that there could be a step down as well. So what happened is this. In this case, and the property was acquired many, many years ago, and it appreciated to a substantial amount. But in terms of the step up, because they held property as joint tenancy with the right of survivorship, only the deceased spouse's half interest was stepped up to fair market value. So
Yes.
she sold this business, which I think, in fact, closed in February, right before the stay-at-home orders were put in effect. The property, the commercial property was sold and it closed, and she was lucky to get that done before this pandemic blew up, because who knows what could have happened with the financing, and the buyer could have had cold feet and gone out. So she got very, very lucky in terms of her timing. So in her case, only 1/2 of the fair market value can be used as an increase in the cost basis. Whereas her share is the cost basis or the purchase price that she had paid when they acquired that property in the 80s. And as a result, she was not able to shelter the entire appreciation from capital gains, and she had to pay a substantial amount of capital gains taxes, or will, during 2000 and during the year via estimates, or next April when she files her return.
Wait, so why couldn't she defer? I mean, she could just exchange it to something else. I mean, for her portion of it. I mean, if she, technically speaking, she could, right?
Yes, but she didn't want to. She just wanted to, and I'll give you a little bit of background. It was a restaurant that her and her husband ran for many, many years. And he got sick and died, and she didn't want to run the business anymore, and she just wanted out. Yeah,
but she still could exchange to something similar.
Yes.
Some sort of similar exchange into, perhaps if the underlying property is real estate, the business itself may not worth much, but the real estate does. That piece of real estate would have been able to exchange to something to further defer her capital gain.
Yes.
Just by some time, pretty much.
Yes. Yeah. That was an option.
Right.
But I think she just wanted out. She just wanted to sell it, get the money, and she didn't want to deal with being a landlord. But you're right,
well,
it was an option.
It would be a very nice option to have.
Well, what about the gifted out? Don't sell, just give it to somebody.
Well, then you have gift tax.
She could have. Okay, hold your thought just 1 second. Let me cover this one point regarding putting it in trust or titling it as community property with right of survivorship, because the answer would be substantially different. So if this asset was a community property asset purchased during the marriage of this couple, and if it was put in trust, in their living trust, for example, in their family trust, or instead of having joint tenancy with right of survivorship, if it was titled as community property with right of survivorship, so instead of the JT, it would be CPWROS. At the death of the husband, she would have gotten the double step up. Not just his half would have been stepped up to fair market value, but the whole asset would have been stepped up to fair market value.
So question, I have
her
a question
gain
there.
would have been and her gain would have been either 0 or a much smaller number than the gain that she had to report as a result of the single or the 1/2 step up.
So my question is, but that's very specific to the community state, right?
Yes.
That's only, so let's say, take my example. So we own property in North Carolina. It's not a community state, right? But California is. And so I would assume if that's the case, and only California portion of the property is subject to that. And then that also depends on the domicile issue, but forget about the domicile for a moment. But I think that it has something to do with the community state specifically, and that's specific to California, maybe. I don't know if it's across the board, all community states is like that.
Yeah, there's 8 community property states, most of the Western states. And Alaska has a strange community property statute. It's new, and they have, in Alaska, it's optional. Individuals can choose to have community property rules apply to them. And I understand that Alaska allows individuals to set up trusts in Alaska, and they don't have to live in Alaska to have an Alaska trust be formed. And they can have Alaska community property statutes applying to assets held by an Alaska trust. So some lawyers on the East Coast who practice in predominantly non-community property states have been taking advantage of this special Alaska statute to advise clients to form these Alaska trusts and puts their assets in there and have community property rules apply even though they live in New York or Massachusetts or in other jurisdictions.
And that's for the purpose of fully step up instead of half of the step up.
Correct.
Okay.
Correct.
Got it.
Now, of course, the concern that I would have is for individuals who are doing that type of planning is divorce. If there's any divorce or divorce is contemplated at some point, that could create a lot of challenges between the divorcing spouses of how to apportion a community asset after community property planning has been done. So that's something to keep in mind. There is, for those individuals that live in non-community property states, there are certain ways to get community property treatment, but there are certain risks that need to be taken into account at the time of planning.
Well, one simple question get it so complex.
Yeah.
That was a fun
Each
sidetrack.
one of these, we can have a 2-3 hour discussion on each one of these bullet points.
Right.
Very excited to hear that. Yeah, a lot of information. Yes.
Yeah.
Thank you.
The third bullet is in terms of the beneficiary. And let me ask you to clarify this point a little bit, Jade. What can you give me a little bit of background on your thinking on with respect to this question?
Yes, that question will come from one of my quiz, but that really 100% make me confused. It said it asked a question under a situation and the beneficiary need to pay the estate tax. So that 100% make me confused. So I list this question here.
Okay.
Yeah.
The when somebody's estate has to be probated, in other words, the assets have to be distributed to the heirs, whether there's a will or there's no will. The probate court gets involved. and the probate court appoints an administrator or an executor. An administrator is somebody who is not named that the court picks, and an executor is somebody who is named in the will. Both administrator or the executor are referred to in the statute as a personal representative of the estate. That individual is responsible of distributing the asset based on what the court says and how the assets have to be distributed. Now, this is in the estate probate context where there's no trust. In the trust context, when a trust is set up during life, usually the individual setting up the trust is the trustee of the trust, and at their death, the document provides other individuals or an organization like a bank or trust company to be the trustee after the current trustee is dead or can no longer serve. And that successor trustee is responsible, does basically the same job as an executor. They're responsible of marshaling the assets, following what the trust document says, and distributing the assets to the beneficiaries, filing returns, and closing the trusts. The trust, paying all of the bills, closing the bank accounts, and distributing all of the assets. Now, the Internal Revenue Code says that if an individual who is officially or unofficially who is officially appointed as a personal representative or as a successor trustee based on a court order or based on what the document says, or even unofficially somebody who has access or who touches the assets, becomes responsible for the payment of the estate tax when an estate tax is due. Now, this is a very, very, very harsh rule that most individuals do not think about when their neighbor or their friend or their relative or cousin call and say, "Oh, do you want to be my trustee of my trust after I'm gone?" And the person says they want to help their friend or their siblings. Sure, why not? Put me down as your successor trustee. But that successor trustee has a lot of responsibilities. And even if they're not listed, even an individual, me as an accountant, for example, if I have a client that dies and I want to be helpful, and I go in and try to help that client marshal their assets, even without any authorization, if I touch those assets, the Internal Revenue Code says I'm responsible for the payment of estate taxes if the estate taxes are due. If the estate taxes are due. Just one, let me make one point, and then let me know if you have some additional questions on this. Now, as you know, that the lifetime exclusion amount was a very, very low number. When I started my working as an accountant in '95, the lifetime exclusion was 1 million. And then it was adjusted for inflation. It went up and up. And then in 2012, it went up to 5 million, adjusted for inflation. And in the Tax Cuts and Jobs Act, it doubled to 10 million, adjusted for inflation. And as a result of the inflation adjustments, it's right around 11.8 million per person. So a couple can give over $22 million. So if you have an individual that dies and their estate or the trust that they have has less than the lifetime exclusion amount, and that is available and it has not been used during their life, there would not be any estate taxes due. So in terms of
So the caveat there is that if it's unused, it has to be elected. If it's not elected to claim that unused amount, it's not going to be available. So the caveat there is, if there's an amount that is unused and you want to take advantage of that, that has to be checked on the estate tax return. Otherwise, it will not automatically grant to you, if you will.
Right. Now, let me give you an example. We have an individual that has, let's say they have a retirement account, a residence, and a rental property. Let's say the total value of these three items is about $4 million. Let's assume also that our individual who died is single. The total value of this individual's estate is $4 million. It's substantially less than 11.8. So if they die in 2020, there's no estate taxes due because they're allowed 11.8 million, and it's only after their estate is valued at more than 11.8 million that estate taxes would be due. So that individual will not owe any estate taxes, and in fact there would not be a requirement to file an estate tax return in that situation. One point that I neglected to answer, but let me clarify it now. Your question is asking is when does the beneficiary need to pay the estate tax? Remember that earlier rule that I said that a personal representative, an administrator, an executor, or successor trustee who touches an asset is required to pay estate taxes if they're due. Now, if that individual distributes the assets without paying estate taxes that are due, the beneficiaries who receive the assets are responsible to pay the estate taxes as well. So the government, the Internal Revenue Service, can go after everybody. They can go after the successor trustee, they can go after the executor, and they can go after the beneficiaries who received assets from the trust or the estate. Again, if there's estate taxes owing.
So Harachi, I think the same rule also apply to gift tax, right? The recipient of the gift, if I remember correctly, if I received a gift and then the donor didn't pay gift taxes on it, the burden's still on me as a receiver. Is that correct?
There is, for gifts during life, the donor is responsible to file a gift tax return and pay any gift taxes.
But what if the donor failed to do that?
Then the estate becomes responsible.
Okay.
The estate becomes responsible. There is a rule, or there is a provision in the Internal Revenue Code that allows the recipients of the gift to pay the gift taxes. And
right, I think that was something that you have to check, right?
Yes.
That's something that you have to indicate, okay.
Yeah, there is some planning that can be done. I'm not familiar with that area, and I can't think of a situation where it would make sense, but I've read some court cases where there was some litigation of a decedent that made gifts to some nieces or nephews, and there was an agreement ahead of time when the gift was made that the recipient would pay the gift tax, and as a result, the burden of the gift tax was pushed down to the recipient of the gift.
I know that. Yes, there's a type of gift. The recipient will pay the tax. I know that.
Yeah.
Yes. There must be have agreement. Yes, that's true.
Yeah. The since we're on the gift tax topic, there's an interesting point, which is there's the lifetime, there's the annual exclusion of $15,000 per person per year. And I had a very wealthy client who had a long list of relatives and associates and friends, and every year he gave $15,000 per person. If they were married, the husband and the wife would get $15,000 each. I tried very, very hard to get my name on that list, but I was not successful, unfortunately. But it was very interesting to read that list because we filed a gift tax return every year. And some of the gifts were taxable gifts. In other words, some of the gifts were more than $15,000, so they had to be reported. Gifts of $15,000 or less per individual do not necessarily have to be reported, but if there's taxable gifts that are made during the year, then we reported all of the gifts as a, just to report it to the IRS and disclose it upfront to them in case there was some arguments or challenges that the gifts that he had made were more than $15,000. But the important point is that there's a lot of individuals that make gifts that are more than $15,000 that would go against the lifetime exclusion amount that's at 11.8 million now, but they don't file gift tax returns even though the law requires them to. And I don't believe that the IRS has been very aggressive at pursuing those non-filers because it's mostly for informational purposes, and there's no revenue or there are no taxes generated by that non-filing because there's zero tax returns. For most individuals, the excess, the amount over 15,000 is going to go against the 11.8, and there are no gift taxes due with the return. So I think the government has decided that it's not a very good use of their time to pursue non-filers of gift tax returns.
I think in general is an honor system.
Yeah.
Just like if you're covered under a employer's retirement plan, technically speaking, if you have already contributed maximum, you're not supposed to contribute to an IRA or a Roth IRA. But I've known so many people who have done that. Again,
Yeah.
it's an honor system. So
Yeah. There's some, if they get caught, there's some severe penalties associated with the over contribution.
Some of them are my relatives. I'm like, I did not hear what you just told me.
Let's keep that between us then.
Right.
Well, hopefully this was helpful to you. I think having some of these questions is very, very important because it will provide us with some discussion points, and I'm happy to entertain other areas if you'd like. If there's some questions or areas you'd like to discuss,
So
I'm
what I
happy
will
to discuss.
do tonight is I will distribute to everybody in the program, whoever wants to join, because I originally only distribute to Hosean's class. But I think that everyone was busy this week. They just wrap up with the final last week.
Oh, okay.
Yeah, because I just submitted the final grades as well. So everyone was busy finalizing their final papers and stuff like that. So I'm assuming that this week is because of that we have a lighter registrations. But I will use your recommendation just to distribute to everyone to see who is wanted to come in for the discussion. But I like the questions. These questions give us a discussion point, if you will.
Great. Yeah, I think it would be good to have more students involved, and I'm glad that Hossein and Chia Lee, you were able to join. It was really nice to have you. And you didn't say anything. Do you have any questions?
Oh, I'm absorbing.
Okay.
like Jolly said, I've with finals last week and then distance learning for the kids, it's
Yeah, it
chaos.
can be a
So
lot. Yeah.
That's enough.
And we have an event next Thursday. Two of our students are being honored.
Right.
Yeah,
We have two that graduate with honor and then being inducted into the Delta Sigma Club.
yeah.
Hmm.
Yeah, I'll be I have it on my calendar, so I'll
Yeah,
join.
it was somewhere. I don't remember, but I know that it's on my calendar of lots of to do.
so
Yeah.
many Zoom meetings, right?
Right.
They are.
Everybody's zoomed out.
Zoom out.
It's online honor.
Yeah.
Is the School of Management having its own graduation? Or no?
I know that everything is virtual.
Okay,
I have not received any actual URL for it yet.
okay.
So
Okay.
I'm just waiting for them to notify, but they are all on my calendar. It's
Okay.
just one after another.
Yeah, that's too bad that the banquet next Thursday was canceled, but
I know. Yeah, it's always a very nice banquet.
yeah, it's very nice. Yeah.
Yeah.
Maybe next year.
Maybe next year. Maybe next year. Well, thank you so much for
You're welcome. You're
for
most welcome.
your
Okay, thank you.
contribution.
Yes, thank you.
Thank you everyone for
Thank
your
you.
contribution. And remember to register and put some questions in there because that any of these could be a great discussion, but you know, Haraj is going to tell you from a practical standpoint, and I'm going to be trying to stay within the CFP exam standpoint. So then you have a good balance in terms of from a practical standpoint, how to advise client, as well as how to tackle the actual exam.
So I have a question. Can I ask? I know we have because this week I have this week and next week I think I have some time. So we have 3 class for the works for this for the discussion. Is right?
Yeah.
So
we have two more.
two more.
Sessions.
Yes. So I can only attend one. Can I?
No, you can attend all 3.
Yes. I just want to attend and just
Yeah.
take a yeah. I just
And you might
Yeah.
want to just submit one question or so.
Yeah.
Yeah.
yeah maybe just hear some information because
Yeah.
that's amazing information. A lot of yes. I want to learn.
Yeah. You're welcome
Yeah.
to attend. Yes.
Wonderful.
Yeah.
Well, that's
Okay.
why we're here.
Yeah. Okay. Thank you. Then.
You're welcome.
Thank
You're
you.
welcome.
Okay.
Thank
Bye
you.
bye.
Okay, great. So we'll remember to register and then we'll see you guys next week.
Next week. Yeah.
Okay, yeah. Thank you,
Thank
Haraj,
you.
and thank
Have
you,
a good
Sam.
night.
Thank you,
Good
Ann,
night.
and thank you,
Bye-bye.
Kate. Yeah,
Bye-bye.
good night, guys. Good night.